I wonder if I could maybe change the discussion a bit and talk for a moment about human capital. And you know, Barry, as you look at sort of internally your own human capital and think about incentives and regulation, even sort of the fee carry model, has anything changed in your thinking in those areas, given where we are?
Again, it's interesting. 6 months ago, 9 months ago, when a lot of funds were underwater and they were struggling with regard to carry and what have you, I think people were potentially more mobile in some respects because they weren't leaving anything behind. And then, of course, as things have recovered, then that's become more difficult for strong guys to come on board. I go back. One of the reasons I mentioned that it's very difficult to operate multiple offices in multiple locations. There's a lot of reasons for it. The ideal scenario is to have one office and one floor and everybody on that floor, in terms of culture and what have you. You ever notice that when you have two floors, all of a sudden you start losing communication? And then when you have an office in Hong Kong or what have you, then it's incredibly difficult to keep culture alive. I don't know how they do it. But the issue that's really increased in the last 12 months is it's not as if regulation wasn't difficult before, but it's almost impossible to stay on top of everything now. And so if you're going to do combat, it's best to do it in my view, one jurisdiction, right, where you can understand the laws, understand how you can execute in that market, whether it be the U.S. or Europe or Asia or what have you, and that everyone comes on with the same cultural expectations and understandings with regard to that. I find that human capital's it's just fungible. Right? It's very hard to play offense on human capital. The best way I've found is that, and I've seen cultures change and different incentives be offered, and it varies by the individual, varies by the market. I thought a lot about this question when you mentioned it before on how to attract and retain that human capital, and it goes back to those fundamentals. You are who you are as a manager or as somebody who runs a firm, and your culture is that, and you have to offer incentives which are best for the firm and for the clients, and you're going to attract certain people and lose certain people. But as soon as you start playing to the individuals that you're trying to attract, then everything else gets screwed up. So I would say try to keep it as simple as possible jurisdictionally, and keep the culture and the finances where you're going to attract the people who are best for the clients and for the firm, and don't play offense in trying to attract people that really shouldn't be with the firm, where economics just don't make any sense.
Yeah, just it's a little bit off your question, but I do think we're about to enter a big change in this topic, because for the last 14, 16, 18 months, there's been very little risk of losing somebody because nobody else was hiring, at least in the long-only mutual fund world. We haven't lost anybody in 18 months. And I think that's about to start changing, where people are starting to think about hiring, about upgrading, and people are going to start thinking about leaving. Again, 9 months ago, people had nowhere to go, so even if they were unhappy, you didn't have to worry about it. So I am now spending a lot more time with my team, listening, trying to get a feel for what issues people have, doing soft management. All the studies that I've read show that when you interview people about why they left, it was more than half the time not money. It was, I wasn't respected, I didn't feel at home here, I didn't like my job. Money matters, and sometimes people will leave because of a massive opportunity, but often people will leave for soft reasons. And for the last year, it just didn't matter because nobody had anywhere to go. But I think really, literally right now, there's going to start to be much more turnover.
Well, I would just, to add to that, I would generally agree with that. The only thing I would say that's sort of one, item that might temper that a bit is that Our industry, up until the crisis in 2008, represented close to, when I say our industry, I mean, the financial sector, whether it's lending or investing or, financial services in general, represented close to 30% of the earnings of the S&P. I think since 1982 to today, one of the things that we've benefited from is that, interest rates have gone from high teens down to zero with, various interruptions along the way. And so for the last close to 30 years, we've been in a declining interest rate secular environment. Now, as we go forward, I think we have, increased government activism. We're going to likely have increased interest rates. And I think a reduction in the general demand as a whole for financial services as a portion of our GDP. And so I think there are a number of talented people in the business, and I think that certainly as the cycle turns, there will be sort of a land grab. I mean, certainly, we have a small team, but the best people that I've gotten, the best distressed acquisitions I've made have been people, out of, other places or places that, didn't make it. But I do think, though, that as we come out of this cycle, you won't see the level of compensation or craziness on a real basis, maybe adjusted for inflation, you will. But the sort of economics that you saw in the investment business 5 years ago, I don't think you'll see that for quite some time on a real basis.
So Jim, one thing you said I want to ask you about, if you said that interest rates are going to go up, and I happen to think they're going to go up, but I'm worried that if I went out on the street and I talked to the cab driver, he would say interest rates are going to go up. Are you at all worried that this is such conventional wisdom that instead we could have what happened to Japan, where 15 years ago they had this problem and interest rates haven't gone up in 15 years? Are you worried that there's such a pile into this consensus view that rates are going up that we're all going to look dumb?
Yeah, well, absolutely. I mean, I'm not, I'm certainly navigating. I think that interest rates are not necessarily going to go up in the sense that it's all in the choice of government actors. So I think the story hasn't necessarily been written. How the Fed chooses to react to the facts on the ground, how other governments choose to react to the facts on the ground will dictate that. And they may make the politically comfortable choice and allow things to kind of continue, and then in which case we'll experience a different type of phenomenon. I think that one of the big takeaways for me from the crisis of 2008, and I don't think it's talked enough about, a little bit, but not enough about in today's environment, is seemingly creditworthy institutions can very quickly, and in the absence of the knowledge of the people who are running those institutions, who are comfortable in their creditworthiness, literally overnight go to uncreditworthiness. And I think that there's a sort of lack of appreciation, certainly in Congress, certainly in governments around the world, for that concern that the capital markets may force that upon them, or they may actually ultimately come to the realization. But so how the government actors will react to those type of events will certainly dictate what happens with rates. But so we'll
I'm just back up for 2 seconds.
Of course.
Because I wanted to talk about something. Charles had mentioned being more interactive with your employees, because this may be the time that they turn over, or start to be the time where you see more turnover. And I think that's true. There's only two things I probably would say. Some turnover is good. Some people you really wanted to stay or try to fight like mad to stay that don't. You look back 12 months, you realize probably a good thing that they left. It stirs it up in the firm, good and bad, but nevertheless, it may force some changes. The other thing that I've realized over many years is that you do find that employees often say, I wasn't valued, or my input didn't matter, or I didn't get a say, and so on and so forth. Don't, though, talk about that as a leader unless you actually plan on doing it. The other feedback that I've heard is, more often than not, is you came around to these focus groups, studies, found out that this, we want more say and more impact, and then nothing happened. And that makes them even more annoyed than had they never been listened to in the first place. So my advice is either don't listen to them, right, and keep it consistent, right? Or if you really do plan on changing, be prepared for that. and open it up, and if people want more say and you're going to give them more flexibility and so on, then be prepared for that. I would argue that most of us aren't prepared to actually give up that level of discretion and autonomy and allow others to play a bigger role in the firm. That's just our human nature. But if that's what you do, then be prepared to do that, or don't do anything at all, and just let the chips fall where they may.
Fair.